section where we talk about the neutral patterns. The distinction about neutral patterns is that price can be going up or down before the pattern, and it can go up or down after the pattern. So the key thing to look for is the direction that price breaks out of the pattern. Where price was going before the pattern doesn't seem to be that important when we are talking about neutral patterns. The neutral patterns are composed by 4 types of triangles. Let's begin by the ascending and descending triangles first. The ascending triangle, as we saw earlier, can be either a bullish continuation pattern, meaning that price will be going up, and then the ascending triangle will confirm a continuation to the upside, or the ascending triangle can be a neutral pattern. That means that the direction the market was going before the pattern is irrelevant. What matters is the breakout direction that confirms the ascending triangle. If price breaks the upper line of the ascending triangle, it means that price is probably going to the upside. If it breaks the lower line of the triangle, it means that it is probably going to the downside. The way to trade either direction is the same as all other chart patterns we saw. We wait for a breakout and then wait for price to retrace to the breakout line or neckline. In the case that price breaks out to the upside, the stop should be below a confirmed demand zone and the target should be at least 3 times as the stop size. In the case that price breaks the pattern to the downside, the stop should be above the upper horizontal line, and the target should be at least 3 times as big as the stop. In the case of a descending triangle, we have the exact same situation. The only difference is that the upper line of the triangle is downsloping, and the lower line of the triangle is horizontal. Once again, since this is a neutral pattern, the trader must pay attention to where price breaks the pattern. If it breaks it to the upside, the stop should be below the lower horizontal line with a target at least 3 times as big. If price breaks the pattern to the downside, the stop should be above a confirmed supply zone with a target at least 3 times as big. Following the exact same rationale once again, we have 2 other types of triangles that finish the category of neutral chart patterns. We have the symmetrical contracting triangle and the symmetrical expanding triangle. The only thing that changes between these neutral triangle patterns is the angle of the upper and lower lines. Beginning with the symmetrical contracting triangle, we have upper and lower lines that converge to each other, so this pattern implies a decrease in volatility. If price breaks to the upside, the stop should be below the lowest low in the triangle or in a confirmed demand zone. And if price breaks to the downside, the stop should be above the highest high in the triangle or in a confirmed supply zone. The target should always be at least 3 times as big as the stop if you want to use this consistently in the long term. The next triangle is called symmetrical expanding triangle, and this one implies an increase in volatility that can be quite challenging to trade. If price breaks out of the pattern to the upside, the stop should be below the lowest low in the pattern or below a confirmed demand zone. If price breaks the pattern to the downside, the stop should be above the highest high in the pattern or above a confirmed supply zone. The target in all situations should be at least 3 times as big as the stop. This finishes off the exposition of the most relevant chart patterns for trading. We can notice that there are a few things that repeat across all patterns. The first thing relates to the proper way of trading these patterns, which is to wait for price to break out of the pattern and then wait for price to retrace and test the line as support or resistance, depending on which side of the line we are talking about. When it comes to chart patterns, this is the best moment to enter. However, price doesn't always retrace to the breakout line or neckline to give you the opportunity to enter. Sometimes price will break the pattern and just keep going. This is a problem because the more anxious traders will try to chase price without waiting for it to retrace to the proper entry point. This is part the need for action and part fear of missing out opportunities. The problem, however, is that if a trader chases prices like that, it necessarily needs to dramatically increase the distance between the entry point and the correct stop loss placement, and that implies that the target must be much larger if the trader wants to respect the correct risk management guidelines, which he or she definitely should. Another way of thinking about this is that if you don't wait for the correct entry point to occur, which doesn't always happen, you will be taking more risk than what's necessary, and your trade will have a lower probability of hitting the target. Some traders will try to bypass this problem by altering the stop loss placement, which is a dangerous idea. If you change the correct stop loss placement because you want to decrease your risk, you will end up increasing your risk in the end, because if you place your stop in the wrong place, you will not have the extra protection of buyers and sellers in the proper zones. So you will decrease your stop size, but at the same time, you will increase the probability that the stop gets triggered. All of this means that if you want to use chart patterns for trading, you will need to have the discipline to wait for the proper entry signal to appear. That means sometimes you will need to see patterns developing in front of you, and you will need the discipline to let price go without trading because the proper entry signal didn't happen. All of this is just part of a dangerous psychological game that is difficult to master, but it is a subject for another course. When we talk about chart patterns, the ideal mode of trading is to watch price breaking out of the pattern, waiting for price to retrace back to the breakout line, observe if price still respects that line, and then open the trade with the proper risk-reward ratios and correctly placed stops. Let's talk a little bit about the advantages and disadvantages of trading chart patterns and the hidden dangers you should watch out for. Let's begin by listing the advantages and then observing some details about them. The only real advantage of chart patterns is their simplicity. They are easy to memorize, easy to spot on price when they happen in their textbook form, and they have a very straightforward way of trading. They also have a built-in logic that you don't need to understand necessarily. That's why you memorize a pattern in the first place. Since they are simple, chart patterns don't leave much room for subjectivity. As far as the list of advantages go, that's about it. When it comes to disadvantages though, the list is a lot longer. Let's begin first by becoming aware that chart patterns are not always that easy to spot, since they can appear almost perfectly or they can be disturbed by a great amount of market noise. The market is not perfect, so sometimes you will need to focus a lot to actually see the pattern forming. Another disadvantage is that chart patterns are not a precise way of trading even when you follow the correct rules of entry, stop, and target. By definition, they will show you a late entry that is better than what you find in technical indicators, but it's still far from the necessary level of precision you need in order to trade safely in the long term. The simplicity of not having to analyze price more carefully comes with the cost of imprecision. If you want to become truly precise, which is a necessity, you will need to learn more advanced techniques and more refined price analysis concepts. There is no way around that. Another big disadvantage is that sometimes the chart patterns will fool you. Since the market has background noise, sometimes price will break the line, then retrace above or below the line, and go to the opposite of what the theory about the pattern proposes. There are times where you can be stopped out just for the pattern to do what it was supposed to do in the first place. There are all sorts of nasty and frustrating little events that can happen around these patterns. Focusing just on chart patterns will blind you to the other opportunities that happen in price. Keeping track of the chart patterns only can be a problem for beginners because that's the only thing they will be able to focus on. The real trading opportunities happen before chart patterns are confirmed, and in many other places in price where chart patterns don't appear also. Chart patterns will encourage you to chase opportunities in the wrong place in the charts. As it was demonstrated before, the proper signal to enter the market doesn't always happen with chart patterns, and that means we will try to chase the opportunities out of a fear of missing them out. This is partly a matter of discipline and part a matter of the unreliability of the chart patterns technique. In a sense, the technique itself opens the possibility or encourages you to break the rules. This is something that almost no one talks about, but it's one of those realities of trading that are silent and yet deadly in the long term. Chart patterns don't exhaust all the possibilities that happen in price action. The famous chart patterns became famous because they reflect certain market scenarios that tend to be easier to spot, but they represent only a small portion of the available and exploitable market patterns. So when a trader limits himself or herself to the use of these patterns, he or she is not only limiting the trade precision, but also the variety of different situations that can be traded. That is something that will decrease the number of opportunities you can see. The really important thing is that you learn the pitfalls and unreliability of this technique. This will make you progress a lot more than trying to perfect an average technique. Notice that I said the same thing about candlestick patterns in the free course I uploaded here on YouTube. The real advantage in these techniques is learning their flaws. That way you can perceive the sort of things you should get away from and the sorts of things you should strive for. Even though I think that these famous trading techniques are completely useless, they can add value to your knowledge if you understand their limitations. Instead of trying to perfect something that is unreliable, you should strive to learn from its defects. Knowing this stuff can also help you when you learn the more advanced techniques and ideas, because then you will have a good parameter to judge the unreliability of most technical analysis techniques in light of the professional price action ideas and concepts. This concludes the Ultimate Beginner's Guide to Chart Patterns. I hope this brief course serves as a gateway for you to find better information and avoid getting trapped into the many pitfalls of the technique. The purpose of the Ultimate Beginner's Guide series is precisely that, to show what the famous and superficial techniques are all about, and then show the bad side of them, what you should avoid, and what you should pursue. If you want to learn more about trading, I have a ton of free content on my YouTube channel. You can find some basic information and some advanced stuff as well. If you want to learn about my premium content, please visit my website fractalflowpro.com. There you will find a table of contents of my paid courses, verified YouTube testimonials, and more. If you like the material I produce, please consider clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.